All right, well, welcome once again everybody to another Hermes seminar. As you know, we video these things and they end up as podcasts and all the rest of it. We had a great seminar last week in Melbourne, all about exits in private credit, and I strongly recommend that one to you. It was a cracker, actually. The content's fantastic. So I've got three excellent guests this morning. Patrick Schweizer, who will tell us a little bit about himself shortly. Ian Hyman and Mark Rainbird, and they've all got some pretty unique skills and insights. They're all very experienced in their fields, and it's a real privilege for me, for these people to say yes when I ask them to speak at these things, because it's very selfish on my part to expect you to come along and speak, and I'm very, very grateful for you. When I was a kid growing up, my father was a Star Trek fanatic. And I don't know if anyone grew up watching Star Trek. Some of you are probably old enough to remember, William Shatner. And it was always, space, the final frontier, and going where no person has gone before. I think that's what he said. They'd be going off every week there'd be monsters and challenges and brand new stuff that no one had ever seen before. And I don't think it's probably a bit of an exaggeration, a bit of hyperbole to say, that I think that the current markets for capital raising for small business and medium-sized businesses are very challenging at the moment. And I think it's fair to say that I don't know about you, Mark, or Ian, or Patrick, there's some real monsters coming across my desk. I was telling Mark a bit earlier about, some large ticket deals, 15, for me they're large, probably small for you, Mark, but $15, $20 million capital raises, and they're very challenging. Because of the amount of easy money that's been around, people have been borrowing money instead of solving problems or working out what's really going on in their businesses and fixing their business models, and that's now washing up on our desks. There's people that they're trying to raise equity, they're trying to raise just conventional debt, and there's a lot of challenges. There's some great businesses out there, and we all want to help them. And the question is how we do that. I think there's also some fascinating. I think the world is going to be very different in 6 months' time to what it is today. The rate of change with AI is incredible, but that's not what we're going to talk about so much today. So with that sort of impromptu setting of the scene, I always like to invoke Captain Kirk. I'm going to ask all of our panellists one by one just a question by way of introducing themselves, so that we get to know a little bit what they are seeing. And I'll start with you, Mark, actually. From where you sit, you're doing equity and debt raising. We were talking before, you're going out to sophisticated investors, and you're also providing advice. What are you seeing in the market right now that business owners and their advisors need to understand?
Yeah, thanks. So at the moment, I think investors are being a little bit cautious. So obviously interest rates have just gone up. We've got inflation. That's obviously still peaking, and then so basically for the investor to have a look at a deal, it's got to be well packaged. So they're a bit cautious. So we've got to make sure it's well packaged. So that's something business owners and advisors need to understand. So just what you were saying before, you're getting. You've got to make sure that if you're giving a financier or an investor some documentation, you've got cash flows and you've got all the detail. And then the other thing they should understand is you need to approach the right investor for the right check size. So quite often people just think, someone's going to write you a check, and that's not true. Obviously, you've got to go to the right people. So you've got venture, private equity, different groups of people to go to. And that's really important based on the stage of the company and what's going on in the company. So one of the things is to get some advice and make sure you're talking to the right people.
Yeah, I'm just curious. I mean, just maybe describe your business a little bit more with this next question I'm going to ask you. I'm just curious. I mean, the thing about I've found as a fund manager, it's always frightened me when we have been doing capital raising. I don't think people ask me enough questions. I mean, we've got all the answers, but when they're chasing yield, particularly when interest rates were low, they were very eager to invest in funds. I mean, with the uncertainty with interest rates, are investors, is there still a lot of money that's chasing yield, and is there any trepidation amongst your professional investors at the moment?
We're actually acting for a couple of funds at the moment, and we're doing a note program, and we're doing some asset-backed yield plays, and we've also got an index fund that we're acting for. So some people are chasing yield, but they're being very particular about the fund they put it in. So they want a fund manager that's got experience, track record. So it's about the governance of the fund, how, who the trustee is and all that sort of stuff. So investors are chasing yield, but they're being careful about where they're putting their money.
Okay. All right, excellent. Okay, Patrick, I guess we were talking before from a litigation and credit data perspective, what changes are you seeing in risk behaviours? But also just introduce what it is you do and introduce your business, just so people can locate where your expertise is coming from.
Yeah, thanks, Nick. So we identified a gap, pretty glaring one, in credit reporting some years ago, where it turns out that basically anything that goes through the law courts currently, or even most prior things that have been through the courts, will never appear on a credit file, be it a commercial file or a personal one. And so, a classic example would be if my business or me personally are getting sued in the Supreme Court for $1 million, I come to you, Nick, looking for money. The fact that we're getting sued is just nowhere to be seen in our credit file, and so without our data, you're likely to be sort of none the wiser and potentially jump head first into a pretty messy situation. So our data exists to provide credit providers with a more complete picture of what it is that they're getting themselves into. So we sit alongside credit reports and provide additional info and insight.
And I would strongly recommend that everybody links with Patrick on LinkedIn, because once a month you put out a report, or is it quarterly?
Once a month.
Once a month they put out an absolutely fascinating report of what's going on, the trends, bank activity, credit, trade supplier activity, ATO activity, and how we're trending at the moment.
Yeah, so look, the ATO at the moment is dominating the data. Perhaps unsurprisingly, they are by far the most prolific suer at the moment of both companies and individuals, and that's on top of their reporting of business tax debt disclosure. So that's now upwards of 33,000 businesses that have made their way onto the weekly ATO list, which is basically debts over $100,000 that are more than 90 days overdue without.
And there's no sign of abatement.
The numbers just continue to trend up. I had sort of intuitively thought that they would have, over time trend down given the impact of that information, but it's doing the opposite at the moment.
You think they'd be running out of victims?
You would think so.
Yeah. Okay.
What about DPNs? Are they tracking in the same direction?
DPNs, there's sort of not a register of those where you can readily go and see the numbers, but certainly in terms of numbers that the ATO themselves speak to, they sort of, from all we see and hear, tend to be trending heavily upwards as well. So.
Okay, that's great. That's great. Well, that's not great, but I mean, it's great that we've got the information. It's great that we've got good sources of data. But yeah, it's interesting. It is very interesting. Okay. Ian, obviously you're a valuer and auctioneer. I'd be very surprised if there's anyone in this room who doesn't know you, but if you could just help out those that don't, describe what it is you do, and just from a valuation standpoint, what's changed in the last 12 months really, and how do you see things in your world over the next, I'd say even over the next interim 6 months? What are the big trends?
So I think, firstly, from the valuation perspective, we're a bit different to a lot of our competitors in the sense we cover property, plant and equipment and business valuation. So obviously the Slattery's, ex-Groves and Pickles and those guys tend to be more focused on P&E, but we tend to see a much more rounded group of clients that come through for a whole range of different purposes, from family law and divorce through to obviously financing and insolvency. We also have a presence in the insurance space as well, and for the very challenging risks, and work with a lot with insolvency practitioners to place those specialist risks. In terms of the last 12 months, it's really been a real roller coaster ride since the end of COVID. COVID itself, as everyone knows, we saw these massive ramp ups in new prices, second-hand prices of all kinds of plant and equipment assets. I'll deal with P&E first. And then we saw from sort of probably the end of 2021 through to 2023 these massive falls in P&E values. And I say massive in some cases for older assets, 60-70% falls in value. And a lot of specialist asset funders got really badly caught with that as insolvencies picked up and their ability to recover from those assets. The other thing we saw as well was a big increase in fraud. So assets being stolen, plates being removed, plates being literally we had one job where director actually manufactured plates to go on equipment himself.
Wow, I haven't seen that.
Yep, and ripped off the manufacturer's plates, and it was just something that was just a bit unusual that this particular manufacturer that he claimed the plate was for, which he made, he put on another machine which was not made by that manufacturer. One of my guys actually picked up and said, I don't think this crowd actually makes this type of pumping equipment. It was pumping equipment. He said, a bit strange. Well, we checked it out. They don't make that sort of pumping equipment. It was definitely another brand. We went back through the PPSR documentation and figured out who the funder was. It was one of the major banks. And so we're seeing quite a bit of fraud at the moment, and assets that are being hidden, so not being able to find assets that are being hidden. So we didn't see that before COVID. That's something that has emerged pretty much since COVID has occurred. So falling asset prices, stabilised in some sectors now, but transport's still very soft. We've seen a huge fallout in the transport space. Obviously construction, larger construction assets not too bad because we've still got this massive infrastructure spend going, like all the state governments and federal government spending like drunken sailors. So there's still, for the bigger equipment, there's still pretty strong demand, but for smaller stuff now we're starting to see that taper off as well. On the property side, again, the market is fairly buoyant. I don't think commercial's recovered yet. It's starting to show some signs, but still very weak. Retail has recovered somewhat as well, which I thought was quite surprising. But industrial residential is still very strong. And in the residential construction space, which is an area we do a lot of work in, what we're seeing is either very small developments now or very big ones. The old days of building 40 apartments, the numbers just don't stack up anywhere in the country anymore. The costs of construction, the delays with councils, all the on-cost infrastructure costs, etc., are so high now that to go out and build a 40 apartment block is almost impossible. So you're either seeing small prestige blocks where the units are selling for 5 to 20 million, or you're seeing 300, 400, 500, 1,000 apartments in the one development. So,
Ian Town.
Sorry?
Sounds like Ian Town.
Yeah,
like it's massive, yeah.
And then on the business side, coming out of COVID, I think growth has been quite challenging for a lot of businesses, and the easy way to get growth was to buy it. So we're still seeing a very strong demand for businesses, and if we see mostly distressed businesses in that space. Some practitioners are better than other practitioners in selling those businesses, but if you get a practitioner who knows what he's doing, then generally speaking, they can get a sale of the business if it's run properly. We work quite closely with a number of practitioners to help them through that process as well, with our databases, etc. So
just to look on the positive side, who's turning up to buy stuff at auctions? Obviously, I was talking before. There is. In the jungle of business, there's reallocation of resources. So are you seeing anything particular about who it is?
I don't think that's changed very much. You're still seeing dealers. It's a big risk for a private person to buy an industrial asset at auction because they really don't have a sense. You don't get enough time to check it out. You can't send in mechanics or engineers to have a look at it. So you get it back to your warehouse or your factory and you install it and suddenly the thing doesn't work and you could be up for a substantial amount of money. So you still see dealers buying a large amount of that specialised equipment, less so in the motor vehicles and maybe trucks, but when you go into even yellow gear now, the costs of repairing a D8 or a D7 or a D6 is are quite substantial. And if you don't pick that up during the inspection process, then whatever you paid for could end up being very expensive. So, yeah.
All right, well, just before we dive a bit deeper, I just wanted to check with Patrick. You mentioned the ATO, but you also track bank data. Are there any trends in bank activity?
Yeah, so interestingly, coming out of COVID, the banks sort of went gangbusters in terms of court recoveries and the number of matters they filed in courts. That then died down significantly in the back half of last year. So the numbers sort of tracking now, almost to where they were pre-COVID, where they had sort of 2024 and 2025, they really boomed. A lot of that, interestingly, has been taken up by the non-bank lenders. So the more specialised type lenders, we're seeing their court activity sort of almost replacing what the banks have been doing.
There's nothing we love more as non-bank lenders than taking a hospital pass from a bank and running into heavy opposition.
Yeah, and look, it just seems increasingly, that the banks sort of talk a big game about being open for business, but in reality, I think a lot of businesses do find it quite hard to get money from the bank, and certainly within the time frame that they actually need the money, which is what then sort of pushes them elsewhere.
All right, well,
Sorry, just on that, we've had a few clients that the bank has said no, and then when we've packaged it properly and tied a pink ribbon around it, done really, quite a detailed job on it, then they've banked it.
You've been around for a while.
But we've normally changed banks, though. We've taken the bank out.
But do you, without sort of...
Like we had a construction one in Perth the other day that we got away that their bank wasn't supporting them.
Right, but are you sort of, do the banks know you when you're sprinkling a bit of your own holy water on the stuff?
Oh yeah, if they know that we've done the work. Then
and you're not going to try and sell them a pup.
No, it's and then the other thing is we don't shop it around. So the other thing is if we go to someone, they've got the deal, and we're just trying to close the deal. We can refinance later, but it's about getting the deal done.
Seeing those deals for the third and fourth time. I've got an ex-employee that used to say all roads lead to Hermes, because we'd see a deal, in June, and then we'd say, look, it's got to be structured like this and priced like that, and they go, well, I don't like that. Yeah. And then 2 months later, it's with a different broker, and it comes back again. You go, well, like I told the last guy, nothing's changed except you've probably deteriorated a bit. And they just keep going. Max comes in, I've got this deal, it's fantastic. And I say, listen, mate, we've seen that one 4 times. But it gets like that. Listen, just sort of bring it back to your specialties, Mark. You are obviously talking with a lot of founders and maybe sort of the next range of the CEOs and what have you. Are there any sort of non-negotiables from your perspective in a capital raising sense that these founders and maybe their broker advisors are missing out on or underestimate?
Yeah, so our first filter generally is people, not the deal. And so I'm pretty passionate about having good governance, so that's one of the things. Because if someone comes to me for money, we take the view that they've got a problem and we've got to solve the problem. If we can solve the problem, we can get the money. But part of the problem is management, because they need the money, right? So there's a problem with management straight away, so that's the first point. The other thing is it's got to be fair value that we just talked about in terms of valuations, and it's got to be realistic. And so that's part of the work that we put in, and also educating the party that we're dealing with. And then the other thing is we see quite often people come to us saying they want the money, but they don't have a plan on use of funds, how they're going to spend it, execution, just when are you going to spend the money, what are you going to do with it, what's the plan? So it's amazing how many people don't have a really detailed plan around how they're going to execute. So if I give them the money, and they still don't know how to run the business, they're just going to go wasted, right? And so as a funder or an investor, that's really dangerous. So then that gets back to governance again. But
I wonder, governance is, unfortunately in my world.
I've talked to you about it a lot, right?
Yeah, I mean, in my world, and some people around this room would agree, the financial statements are just so poorly put together, if they exist at all. And you do find yourself trying to fall back on bank statements and these sorts of things. But I'm just curious, one of the interesting challenges that I find is sometimes people don't understand the difference between balance sheet asset risk and business plan equity risk. I mean, do you ever find yourself having those conversations, helping people understand the difference?
Yeah, I guess the other I'll answer it a different way. The other thing we do is we get in and from a management accounting point of view, sort out the accounts, but that helps that discussion in terms of what's actually on the balance sheet, because quite often there's stuff that's not on the balance sheet and it's everything's been depreciated and it's not showing a true value, obviously. And that's where valuations can come in terms of actually getting someone out and valuing the assets and understanding what's real. And I guess you do that if you were funding something, right? And then on the other side, if I'm lending or we're bringing investors in, it all gets back to cash flows. So what cash flows do they have? So that gets back to the management accounting, putting a financial forecast together, all that sort of stuff. And then quite often we send a forensic bookkeeper or someone in, like are the super balances up to date, the ATO stuff, like just is the accounting right? So that's the other thing we do is we send the A-team in. To make sure you know what you're dealing with. Because then when we've done that DD, or like is their WIP under control? Like we see that quite often, people's WIP's not under control, they're not booking that properly, or if they have a problem there, they're writing off a lot of money, which affects the financials, So that's stuff that we do to make sure. Okay. But then when we've done that, then we take it to the financier or investor, then there's confidence around we're on solid ground in terms of how to move forward.
Can I ask you, the other thing is valuation of a business. And I've seen over, I'm now, because I'm 60 plus, I can now sort of start talking like an old wise man, and I say to people, listen, I've been around, and using the lens of my experience, I can see your future, And one of the futures I see is when people think their business is worth this much, it's really worth that much, and if they just took that much and took it to the bank, their future their life would be so much easier. But they hang on, inevitably something changes, and all of a sudden the buyers are gone. I mean, so how do you have that conversation?
Yeah, it's all around people, right? So you've got to educate the party. So there's two questions I normally ask: what do they need, and what do they want? They normally come to you with what they want. I want $10 million and this, and my business is worth X, right? But that's not what they need, right?
Right.
So quite often, if they took what they needed, they would get out of jail or can move forward. But quite often they go to the market with what they want, and they're too greedy.
Yeah.
And so somewhere in between is probably the right number. But yeah, I agree. It's problematic.
Well, one of the things, Ian, that it's interesting. I mean, obviously, business valuations is subject to multiples and all sorts of forecasts. Profit forecasts. It's all a little bit airy-fairy to some extent sometimes. But obviously, hard asset values are a little bit different because the market speaks to you. I mean, when what do you find is the biggest disconnect between what owners think their hard assets are worth and what the market will actually pay?
Can I just add something to what Mark's saying about the business valuation side, because we do about 150 business values a year, and probably of the 150, 135 to 140 have got the most appalling balance sheets and profit and loss statements. And unfortunately, even though a lot of directors know that their accounts are rubbish, because of the way that they account, they believe that their business is worth a lot more than it actually is. And now the hardest job that we have in any business valuation is actually getting to the starting line. The starting line is having a set of accurate financial numbers as at the last balance date, and be able to sort of track that back 2 or 3 years so we can see the trends that are emerging from that business. And that can be very challenging and take a very long period of time, because either that information, they resist providing that information, or they simply don't have it. Don't have a good internal accountant, and it makes our job very challenging. So we end up having to qualify and make valuations of what we call limited scope because we simply can't get enough accurate data to make the reports meaningful.
Can I just interject there for a second? I mean, I'm finding now, I used to be a big sceptic of bank statement analysis, but I'm a convert. You know, if you dump in, if you analyse 3 years worth of bank statements, the bank statements don't lie.
No.
I mean, there's a lot that they miss out on, but you know, if the business is, there's a lot, particularly with AI, there's a lot you can interpret. Is that coming into what you do? Or?
Yes, it depends on the business.
Yeah.
So when somebody in a retail business says, we don't take cash, because there's no cash on their bank statements.
Right.
You know, we asked to see.
These are the non-Greeks.
That's right. So, you know, we asked for bank statements in the first instance as part of the last 12 months bank statements, and we ask obviously for all that financial data that we request and how they recognise cash within their business. And when you get somebody that says in a business that is particularly in the food and beverage space that they don't take cash, it's obviously complete crap. Trying to reconstruct those types of things, we use rules of thumb and you know, where the business is located and where we think those cash results might be to come up with and try and reconstruct those financials to get a more accurate picture.
Okay, so just back to the scripted question,
yes.
if I'm right. What's the sort of disconnect between what you think? I know that sometimes you're the source of disappointment for my borrowers,
yes.
And sometimes otherwise. But you know, what do you find are the factors that are contributing to?
So there's a lot of information
in hard assets.
Yeah, there's a lot of information online about hard assets. There's numerous websites where you can go online and see hundreds of thousands of assets that are for sale. I think a lot of asset owners look at those websites and think, oh, they've got 100 grand of that. I've got one of those. That should be worth 100 grand. The fact is that by the time that asset gets sold, it'll have gone from 100 to 90 to 80 to 70 and probably got sold at 60k somewhere down the track, maybe several months later. But people tend to see what they want to see. What they don't take into account, for example, when a dealer offers an asset for sale, is that first of all they've serviced it, and that could incur significant cost to bring that asset up to a condition that they can then on-sell. Then they've got to hold it until they get a sale, and then they've got to warranty it for even a short period, 1 to 3 months after that piece of equipment goes out. So they've got an enormous amount of risk. So that cost structure probably adds another 30-35% to their cost price, and then they've got to have a margin. So on top of that, the margin is probably running 25-35%. So when you look at all those things in place, if you're a private seller trying to sell an asset, you can't look at a dealer price as a relevant measure of what your hard asset is worth, and that's what we battle with. Is what these people see. They don't look at the auction prices. They look at what the dealers are selling things for, or what somebody down the road has put it up on some plant and equipment website has put on it, and they're just not relevant numbers. Well,
sometimes I know myself. You know, there's a particular car you'd like to own one day, and so I've got the little alerts coming from car sales, and you find that the same car's been there for like 2 years, literally. And it's obviously someone's gone, well, if some idiot's going to pay this much for it.
But car sales is a fantastic example because you'll find, let's say a Hyundai i30, you'll find 40, 2022 Hyundai i30s on car sales, and the price with the same similar kilometres, similar conditions, similar options, and the price variation could be 30%. And that's the reality of it. The people just they don't really have a sense of where the market is, and they look at the wrong indicators to form their own views. And generally, they tend to be higher than lower. They don't take the lower indicators; they take the higher indicators. And if you look at car sales, you'll find the ones that are realistic, they sell their cars in a week. The other blokes and ladies, they take 2 years, or never, or don't sell it.
All right. I mean, it is interesting. I think that one of the important value adds that a business advisor or finance broker is to have the hard conversations with their clients. So that they understand the true value, or that understand what's really going on with respect to asset valuations, be it business valuation or otherwise. And of course, the trouble, the hard part for a finance broker or even someone like me going into a deal is that you give the client the tough medicine, and of course they don't want to talk to you anymore. They want to go to the next person, right? The next advisor, and it's the same in insolvency as well. I'm sure where you go, well, listen, if there's only one way you're going to solve this problem, they go, I don't like what Bill's just told me, that's a load of rubbish. And then they go to the next person who maybe tells them a bit of a porky. And, you know, so it's interesting. I mean, I had to have a hard conversation with someone a couple of days ago where they're trying to raise some money. They've had part of their business that's gone. Really good business, been going for 50 years. Well, it was really good for a long time, but they just misstepped. And all of a sudden they're not, you know, I'm sitting in front of them. It's not Westpac, NAB or Judo or whoever. And so there is that reality check as to what the business might be worth, what the assets might be worth. Patrick, just to sort of change tack a little bit, I mean, I'm mentioning, you know, business advisors, finance brokers, capital raising advisors. I'm wondering, with the data, do you get advisors using your services? And how can they, if they do, what's the early warning signs so that they maybe can package deals better and get in front of the bad news to be able to sell it better?
Yeah, absolutely. So we've got a couple of different scenarios where brokers or advisors use our data. So there's instances where a lender who uses our data may sort of start to push some of the searches back down to the brokers and say, hey, look, you know, before you send me a deal, run these extra searches as well and include that as part of your package. Then there's advisors who more proactively will say, hey, we've had a few deals get knocked back because it otherwise looked great, until the lender ran a lower search and found out that, you know, the borrower is sort of getting sued by half a dozen other people already. So rather than have that scenario happen again, we'd rather do the searches up front so we're aware of these things before we put the submission forward. But the key things to look out for, you know, there's obviously the ATO element, not to harp on that, but I do remember a time not long before COVID where in a lot of circles it was actually considered good business to run up an ATO debt, because why
During
wouldn't
COVID,
you? It was,
yeah.
you know, it was free working capital.
My biggest competitor.
One nice phone call and you can get your interest remitted. You know, you'd be a fool not to, is sort of how it was described to me. Those days are well and truly over.
Can I mention that we actually saw it in an IM once, that they actually wrote in that IM that they were on purpose, you know, not paying the ATO to help with cash flows.
Free working capital.
And they put it in writing and you just go, man.
Yeah.
I'd love to get into you know, the allocation of capital in a free market and the role of crowding out by government in investment. When there's someone that's willing to put the money up, the government shouldn't be competing with me. But we won't go down that path.
But look, beyond that, it's you know, the key telltales are if other lenders or other credit providers that might be supplied to the business, if they have launched any legal action, that's obviously a big warning sign.
Well, the other thing is, doing a search with you doesn't leave a footprint.
Exactly.
Right? So it's not like a search where it's a credit search and someone can see you've made the inquiry. And, you know, with this large matter I had the other day, I thought, well, when I'm sitting in front of the client, they've been going for 50 years and they've got lots of assets, and I'm thinking, what the hell am I doing here? This is embarrassing. The broker's brought me out here. I think he's mistaken me for Westpac. And he's never going to... But then, you know, we, of course, inevitably... you know, is this equipment? No, it's not encumbered. You know, you run the search, you find out, well, actually, there are a couple of charges. And, you know, we do run your searches because let's just get all the bad news out on the table and then we can deal with it.
Yeah.
And then we can put up the right structure that's going to solve the problems, rather than you think you've got a great structure, everyone's excited, everyone's running in one direction, and then you find out, oh, yeah, we didn't tell you about that. And it's something we could have found out 2 weeks ago.
And that's exactly, that's what we hear a lot, that feedback. And it's not, you know, from our point of view, it's not a matter of, hey, you need to put a line through every deal that might potentially have a problem. It's more about knowing what the problems are when you go into the deal so that you can actually structure it appropriately.
It also gets back to my point about people, right? So if they're not disclosing and then you find that they're being sued or, you know, the ASIC's taken action or, you know, and we see that a little bit, you know, they're potentially bad actors, right?
Depends who you are, Mark. I mean, if you're a salesperson You love to look past those things, but our general manager gets this bad information and makes some very harsh character assessments. Would I be right about that, Max? Yeah. The hanging judge, on comes the black cat.
I was going to say, but the other thing on the equity side, you're raising under the Corps Act, which is a criminal offence, and so you can't mislead and entice. So it gets quite dangerous if you've got directors that are essentially, erring on the negative side, right, in terms of what they're telling you, right?
All right, listen, let's move on. Ian, when a business hits distress, how much value evaporates in the plant and equipment? I mean, can it be worth something today and then all of a sudden it's worth a lot less tomorrow? I know that one example is when a business is running out of money, they're not maintaining the assets and there's wear and tear and what have you. But what do you find in that?
It can be worse than that. You can see, and we've seen this many times over the years, where somebody's running a fleet or something, and in order to keep trucks on or ELO gear on the road, they'll remove components off one piece of equipment that are financed by one finance company and put it onto another piece of equipment financed by another finance, just to keep the things going. So that does happen.
Don't give people ideas, for God's sake.
I think the big challenge with looking at value like this is that we've got lots of different definitions of value. You've got market value and continued use, MVICU, which is going concern value. You've got market value, which is willing buyer, willing seller, but you've got to rip it out. You've got all liquidation value, which is sort of compressed time frame, but not quite at auction value. Then you've got auction value, which is, basically just stop everything, sell it, and get it out of the premises. So when you talk about value, obviously, it's all about time. Time and place are the two critical things about being able to maintain a value or maintain a price of an asset. So the more specialised the asset, often the more time you need. So therefore, you'll see significant degradation or price degradation between a going concern value and an auction value if a highly specialised asset has to go to sale and be sold in 2 weeks' time. That's just a reality of it. The other aspect of that is that if the asset is 200 kilometres west of Weipa in a mine up there, and to get it, you can only move it during the dry season, it's 2,000 kilometres to the nearest likely sale place, the transport costs and relocation costs are just horrific. So that has a material impact on the realisation. I've actually had that situation happen on a mine valuation we did up west of Weipa, and the funder rang me and said, I can't believe how little these assets are worth. And I said, well, mate, we are 1,000 kilometres from civilisation, basically. And I said, if those assets were in Brisbane, they'd be worth not 3 million, they'd be worth 15 million. But the cost of dismantling, getting a crew up there to actually dismantle the mining equipment that's there, the processing plants, the crushing plants, etc., and bringing those back possibly to Cairns, and then maybe to other places, means that it's just not, we just lose so much value. So time and place are the two things, and those strategies, whether it's going concern value or forced liquidation value, you need to pick your two best strategies and run them almost at the same time, so that if the going concern strategy falls over or the market value strategy falls over, you're ready to go into an auction. That means having your cataloguing done, your website set up, ready to hit that button, because often at the back end of this process, landlords, no one wants to pay rent, no one wants to pay all the holding costs and the other issues. Finance companies want to get their money back, but you want their gear in the sale to make it more attractive and to share the cost of sale. All those things impact. You just need to have your balls in the air at the one time to make sure you can maximise the return.
I guess sometimes we're better to sell them as a going concern before, before it hits the fan.
Well, that ideally is, and we see that quite a lot.
Yeah, but of course people don't necessarily want to see the situation. Mark, I am curious, in a distress scenario, people are trying to raise money, you think you're not going to get debt because you don't have the assets, they don't have the balance sheet. What you really need is equity, but of course equity coming in doesn't want to pay out debt, right? Equity wants to contribute to growth. Typically. So, where you've got, maybe a deteriorating cash flow position, maybe not enough assets to cover a debt raise or a strong enough story for a debt raise, but you have a strong underlying business, when should the founder consider equity, and how do you sell that equity in the market that you operate in?
Yeah, it's an interesting question. So the issue with equity, there's a couple of things. One is it takes time. So, obviously the company would need to be packaged up. Part of the issue sometimes is structure. So we see it a lot in agri-businesses, for example, where there's just trusts everywhere and you can't bring equity into a trust structure generally, so you've got to sort out the structure. So there's a structure issue. But the main thing is it takes time. So you've got
time the business may not have.
Well, so I always say go get money when you don't need it. As soon as you're distressed, the cost of money goes up basically. And then, but if you're, so the main thing would be to monitor your cash flow, get advice around options. So we have other options, for example, where we might be able to bridge. So quite often, one of the reasons we called it one of our company's funding strategies is people don't understand how to fund something. So we might bridge to another event, but the bridge is not the main game. It's to bridge to getting the equity, for example. So we might do a bridge, get them out of trouble.
We've done those bridges to equity.
I'm just saying. There's different options, right? But in the meantime, you're running hard to get ready, and you're going to the right people, and you're warming them up. But in the meantime, you've got a bridge, so you've got working capital or whatever.
Can I ask you, last week's seminar in Melbourne, it was all about the exit in private credit, because obviously when you go into a deal, particularly in private credit, you want to make sure that you've got a good exit planned. And I was musing over this with my friend Ian here the other day. We had a particular deal where he was lamenting that, you go from, someone's got bank debt, and then the next thing they go to a second tier lender, and then they go to a third tier lender and a fourth, because the exits are badly planned. And the client's getting skinned alive as they go down that curve. But just if you came to me and said, I want $5 million to bridge an equity raise. Firstly, equity raises always take longer than what you think, and they don't necessarily get away. How do you sell that equity raise to me so I've got confidence it's going to happen?
Well, it's all the stuff I just talked about, right? So you've got to have a plan, execution, people, cash flows, and there might be some event in the business that we're creating. We might be selling assets or doing whatever. But essentially, you're looking at all the options. We're helping the party execute those options, holding their hand, if you like. So quite often we might jump on the advisory board or something around the company to give some
sometimes
some comfort, right? We won't jump on as a board, but the advisory board, right? But then they're getting someone holding their hand, keeping them accountable, making sure they're okay, and then working through some options or giving them options. But like we had a deal that a bank referred to us, and they wouldn't bank the company, but they were banking the founders, so they had their houses.
Right.
But the company got into trouble, and then we went and got some working capital, got them out of trouble, put some governance in place, and then we took it back to the bank, as an example. Right. And then they got banked.
Okay. Okay. Anything to Ian?
Well, I was going to say the other thing is if they're in trouble, the other thing is quite often it's like the deer in the headlights. So and this sort of gets back to from an insolvency point of view and heading down that path. So quite often management is the problem because that's how they got there. And so the other thing is you need some other people around the business, and that's sort of my advisory board type idea. Or you've got to drop some other people into the company that know what they're doing. Or so there's a people thing around.
Well, that's a whole other discussion around change management.
And then the other thing is people assume that they've got time, and quite often the financier is going to take action. Depending on how bad it is. And so people have got to make sure that they're prepared. Like I've got one at the moment where a party's in trouble with the bank, but they haven't taken any action yet, and the bank.
But very often there's a really good underlying business, right? It's just that there's maybe been a decision's gone wrong. This one I looked at the other day that invested $5 million in a machine that they hadn't finished building the factory for. And there was, inevitable delays in building the factory. Meanwhile, this machine's eating its head off in monthly repayments. So the fundamentals of the business are there. The business case for the machine was there, right? It's just there's been this terrible timing mismatch. And, so it's gutted their cash flow, right? and so there is fundamentally a good business there. So how do you make that assessment that it is worth?
Well, you've got to put the case together and show via the numbers, I guess, that it's worth supporting, right? And then the other issue for the equity investor is how they get back out. So quite often we'll do a convertible note or do some other instrument, so it's safer for the investor, right? So they're getting a coupon on it, maybe, and then they can convert to equity if they're happy. So if the plant gets finished and the machine's okay, then they can convert and they're all okay.
Right.
So we have mechanisms in terms of structure.
Yeah, very interesting. We might have to talk about that a bit later on. Okay. What I'm going to do is just ask you guys one more question, and then we're going to go to the floor to see if anybody's got some questions. So just sort of start thinking about your questions. What was it going? Actually, I'm going to ask that same question of everybody. If a business has got strong assets but deteriorating cash flow, actually, this is my question to the panel. I'll start with you.
Sure.
If a business has strong assets but deteriorating cash flow, what's the first call? Who's the first call they should make? Who's the first person they should pick up the phone to?
That's a great question. I'd like to say the valuer, and I say that sort of half jokingly but half seriously, because so often the valuation process, which is the foundation of almost every lending decision that is made anywhere, is almost an afterthought once the strategy's worked out and somebody goes, we need valuations, but we need them in 7 days, and we're talking in some cases tens of millions of dollars worth of assets, and it's simply not feasible to get that done within the time frame. So certainly you need to identify your valuation requirements right at the very beginning, and I would have thought, depending on the level of distress, you need to be talking to someone like Bill or Brajesh about, okay, it's the old story, hope for the best, plan for the worst. What happens if I can't put a deal together? What is going to be the next stage of that process? And maybe I've got to go through an administration and a DOCA to be able to actually put things back together again. And so I think probably simultaneously, I know Bill would probably call me anyway, but hopefully. But fundamentally, I think if you in that distress situation, I think seriously the values are a really important part.
Well, I think there's a couple of things there. I often find myself, particularly when I'm talking to people in the project, civil engineering or construction industry, I always like to use their lingo. And they say to me, the first thing they say is, well, I don't like your pricing, I don't like your structure, and what's the third question, Ian? Well, yeah, okay, I don't like you. The next question is, I don't like your pricing, I don't like your structure, how quickly can I have the money? Is usually the third question, right? And I usually say, well, the critical path, that's my little project management drop in there, the critical path is the valuation, right? Because it depends if the valuer is available, because it's going to take some time. They need to, particularly if it's complex, like obviously if it's a 2-bedroom apartment in Parramatta, it's easy to value, but if it's some sophisticated piece of equipment...
You don't get too many 2-bedroom apartments in Parramatta.
I don't get any, but that's the critical path. So there's a timing issue there. But the other thing is, it's a bit hard to imagine having the conversations without really knowing what the stuff's worth. Like otherwise, how can you make your decisions about the options?
We get calls directly from directors all the time saying, I need a valuation. I've been told to give you a call, I need a valuation ASAP. I just say, guys, procrastination is your enemy. So we'll give them a quote. It'll take them 2 weeks to come back to us and say, yeah, please proceed. Then it'll take them another week, we'll issue an invoice, then it'll take them another week to pay the invoice, if we're lucky. And then suddenly it's like, oh guys, my DPN expires in 2 days' time, I need the valuation. I can't, go away.
Like, this is when I trot out my speech. Oh yeah.
So, yeah.
They don't want to know. It's a little like men going to the doctor, We know there's something wrong, we don't find out, really. Patrick. Someone's in a little bit of distress, a bit of trouble, who's the first person they should call?
Look, I think, as Ian suggested, that they really need to call an advisor, whether it's somebody like Bill or somebody like Mark. I think in Australia we sort of have a cultural, issue in a way where people invariably, leave their issues until it's too late. So, all of the insolvency practitioners we speak to, they, sort of you hear time and again, look, by the time they, come to us, it's invariably too late, and then, the options are sort of very limited where, it's sort of VA liquidation, very rare that you can do a turnaround. But yeah, again, just, tackle your problems early and sort of don't bury your head in the sand.
Well, it's interesting because one of the banes of our existence is when it comes to that head in the sand. One way that you can keep your head in the sand is by getting some easy fintech money, and this money is priced at 150% per annum. People don't realise that. I can do the maths, and it's just made things worse because the business, it's got a cash flow generation problem. There's some issues they need to solve, but meanwhile they're bleeding this money and their head's in the sand. As I say, they're buying the next hit. But this is one of the things that facilitates that. So it's not just a people put it off; they're being facilitated. So or enabled might be the word. Mark, who's the first person that someone should do it? You, apart from you, obviously.
Yeah. So, well, I think everyone's answered it already, but basically the parties need to understand what their options are and get on with it. And then, obviously need to understand if they've got shareholder or supplier support, so you need to go and talk to your friendlies, who can help support the business. So quite often you can get better supplier terms or work with your suppliers around cash flow and start managing it. But again, it sort of gets back to the management accounting around understanding your cash flows and just then start working through some options about what you can do. And then the structural options and all the stuff you just talked about, and assets, obviously.
Yeah, okay.
Or sell a business or sell part of the business.
Well, I think something Ian was saying before, like if you've got some kit out, 1,000 miles from Weipa, how do you tell someone, look, you're not going to make a go of this. You need to, if this thing goes into the ditch, you're going to lose everything. Why don't you try and sell it as a going concern?
But even quite often when I walk around a factory or whatever, there's idle kit just sitting there that they haven't sold, that's just cash sitting there, inventory, like just skinnying down, being really focused on what your core operations are, stop doing the other stuff, get rid of stuff.
Yeah. I mean,
just turn your inventory into cash. There's a whole range of stuff you can do if you get in there and really work it.
Okay, so we haven't even discussed inventory today, but that, in terms of the balance sheets that we see, both from at an insolvency point of view, almost never is the stock records accurate. I mean, when I say not accurate, they might have $2 million worth of stock at cost on the balance sheet, but 1.8 million of it is obsolete, basically worth not a cracker. There would not have been a company in living memory that I've seen where they have stock, where the stock is actually aged properly and provisions are made for obsolescence in a sensible way. Not one. And I'm talking about some really big businesses in that over that time. So stock and inventory are a huge issue for most businesses. They just don't deal with it because the ramifications are so serious if you don't have an ongoing, almost daily, weekly, monthly process to move on obsolete stock. Suddenly it is the elephant in the room.
Well, another issue is, which I don't want to sort of go down this rabbit hole because I want to give everyone the opportunity to, but another issue is as soon as you do, let's say you do fire sale that stock, because it's better off cash in hand than it is sitting in the warehouse. You're paying for, the costs, holding costs, etc. But of course then it's going to affect your GP, and if you're a larger business that's reporting to the bank wants to know what happened to your margins, and it's not just not you that you're answering to. There's a whole bunch of other covenants and things that come into play. I'll ask any questions from the floor for any of our panellists.
Yeah, you mentioned before when you're valuing businesses that you look at, all these businesses. Why are the P&Ls and balance sheets so poor?
So just to repeat the question for in the microphones, why do you think the financial data is so poor?
Look, in many cases, it's a really simple fact that they don't have an internal accountant that is competent. And having run a business for 43 years, I can tell you how hard it is to find good accounting staff that actually, and mate, it is complex. $1 million in payroll, you've got payroll tax, you've got workers' comp, you've got all these other things. We see businesses now, we saw one only a few weeks ago, $15 million turnover, never registered for superannuation. We're doing a business file for family law purposes. Have never paid or provided $1 in super. We ask the question, where's the super? Yeah, look, we never quite got around to that.
Yeah,
Right,
my
yeah.
son's got a startup, and one of the first people I've introduced him to is my accountant, because you need to get all that stuff right to begin with. I mean, it's not core, so to speak. It's not finding your first customer or developing your product, but if you don't do it, the man's going to come and get you. Well, the other, in fairness, in defence of accountants. I would like to stand up for the accounting profession. The trouble is, you say there's no defence, but how hard do you work for free? And very often, what often happens is, and you might attest to this, you get the financials are rubbish, and the accountant hasn't been paid for 12 months, and it's no.
And that's the external account.
Okay, all right. Okay,
So
sure,
I'm talking about the internal account. The other and probably even more important thing is that so many, even reasonable sized businesses we see, literally they run the businesses, the directors run the business like it's their personal bank account. So, and a bookkeeper and an accountant internally, they'll just go along with that. If the boss says, the helicopter I bought's in the fuel's we're going to write the fuel off as part of our transport diesel and whatever, and the servicing costs are going to be written off, and the insurance is going to be written off through the company. What's a bookkeeper going to do? If he wants to keep his job or her job, they're going to just toe the line. And I've had this conversation with some external accountants where we've been involved in shareholder disputes. I say to the external accountant, you've been the external accountant for this firm for 20 years. It's turning over $25-30 million a year, and $5 million a year in profit is being siphoned off by the family for illicit activities. Illicit? Well, I say illicit, i.e. running expenses. They did a property development in another company, ran all the development costs through the main entity, right? And they've been doing it for 20 years. The tax liability, the criminal tax liability, will be absolutely massive. I said, mate, you've witnessed this. He said, what am I supposed to do? I said, mate, if I was you, I would have resigned. I would have said, guys, we either straighten this out or I'm resigning. Oh, would you really? Okay, mate, I absolutely guarantee you I would have.
I had an accountant the other day who approached me about raising money, and he was doing another business, and I said, where's the P&L and balance sheet for the business? Yeah. And he said, I've run it all through the accounting practice. And that's the accountant.
So it's a major problem.
It's a massive issue. And I do blame, and I do think, mate, ASIC, the most ineffective government authority in this country, and probably costing us more than almost anything else, mate, they just ignore this stuff.
But, sorry, we've seen it quite a lot where the bookkeeper in the business has been trained by the business, is not a proper bookkeeper, or hasn't been formally trained, and so we've had clients where you start asking questions about the accounts, and then you say, who's the bookkeeper? And they say, yeah, we've got 2 bookkeepers. And then you start talking to the bookkeepers, and then we talk to the accountant, the external accountant, and then the external accountant says, I'm too busy, I don't have time to look after them. The business is firefighting. So there's this whole range of stuff going on in the business with the founder and how they're running it, and then the quality of staff. But you've got to sort all that out if you're going to get valuations or fund it or get cash flows. Or
I was going to say, don't get confused between data processors and bookkeepers, because seriously, with all the software that's available now, you've got the data processors basically just processing data. They have no understanding of what they are processing. They just do what they're told. End of story. There's no input, no intellectual input whatsoever.
And then obviously most companies are minimising tax, so they're expensing
It's
everything.
a generous way of describing it.
To Ian's point. And so, stuff's not on the balance sheet or it's not in the right bucket in terms of the accounting.
Okay. Any other queries, questions?
Okay, we've just completed a valuation last year for I can't name names, but a transport business has 1,000 trucks and trailers. Almost 100 assets are either been destroyed, sold, written off, and they have no idea what they are. No idea. 100 assets. 10%. Yeah, absolutely. It's chronic on every depreciation sheet.
Or they're stolen.
Or stolen. Yeah.
All right. Any other questions, Bill?
Thanks, Nick. Yeah, it's the first time I've heard Dr. Mark speak. It was actually really interesting. And one of the comments you made was to ask for money when you don't need it, not when you need it. And I guess my question, more my thought for the panel, interesting because everybody I think adds to education as being the key point. We need to educate people early. We need to make sure directors in good times are listening and using services like like Lera's, and they can actually find out a lot of people when we do that, they don't even know that they have got court proceedings against them in other jurisdictions. That's the first time we've heard of it.
Yeah.
And it's been sitting on their database. It's an education base. How do we get to these people first? How do we get professionals like the people on the panel first to the market in this day and age when they're all out there on the internet, on the AI, asking computers to help them, sitting in the dark times trying to figure it out themselves.
That's a good question.
Professionals out there first?
Mate, it's hard to get over the top of ignorance, and there are a lot of ignorant people out there. They don't want to know. They haven't got time. They're too busy.
But it is a human nature thing. I mean,
totally.
the people, it's a challenge for all of us, right? Because it's like I was saying before, nobody wants to be the one. Well, unfortunately, we are the ones that tell the client this is the way it is. I know you don't like what I'm telling you. Maybe you need an insolvency, or you need whatever it is. This is the structure, and we all know that the more honest we are, the bigger chance we got of them just shopping to the next person who's going to lie to them. That's a real problem. But I think that it's interesting. One of the reasons that they brought in Safe Harbour was to try and encourage people to face their problems earlier. People say, you should, if your company's in Safe Harbour, that should be on a public register somewhere. But no, the whole point is it's not on a public register, so you can get early help without the whole world having to know your problems, because that's one of the things. That market's, sorry?
I don't think it's made a big difference.
I think we don't know, because the idea is you don't know. It's not reported. That's the whole point of it. It's like, does it make a difference? Stop smoking and stop drinking. I mean, because it's like you can't. It's like proving the negative. I don't know if I've said that right, but you know what I mean. We know when people are dropping off. We don't necessarily know that company is still here because they went through a Safe Harbour.
So I'll give you an example, about getting money when you don't need it. So during COVID, I went and got a loan, and I think I paid 3% interest, right? So people complain about the interest rate, but interest rates have been really low, right? So why wouldn't you get money when it's cheap, right?
Yeah.
So, but it's about just being sensible about the market and understanding the market. And now interest rates are going up, and then people are going to get more distressed in a minute because interest rates are rising. Right?
Well, you've got the discipline to do that.
No, but I'm just sort of saying it makes a difference to your business, right? And so one of the other things we're really big on is making sure a business has got a safety net. So because banks aren't giving overdrafts anymore, it's just basically trade or receivable financing or whatever. And so, there's a big issue with, do I have enough cash in the business and enough?
Well, people often say to me that the hardest part of doing a business valuation is coming up with the multiples. But in actual fact, that's the easiest part. The hardest part is actually getting to the starting line.
To know what to
multiply. Absolutely.
Just touching on human nature and ignorance, conflict of interest is a big thing. And advisors, we love to, the solution here seems to be just get advisors into these companies and whatnot. A lot of directors don't want to do that. We see as lenders all these situations where we wish we could be the advisors, but conflict of interest is a big thing. We'd love to vertically integrate it and chop and change and be that helping hand. Same with you, Ian. Same with you. Everyone sees this. They would love to advise, but they can't. Do you think the bad actors that abuse this conflict of interest process, and now we can't, there's all these boundaries and we have to stay in this particular thing. Do you think that's providing more good, or is it actually going backwards? Where's the middle?
Well, I'm really passionate about this because it's real, right? And so it sort of gets back to, on the one hand, from my point of view, the lender's got influence over the client because you've got leverage because you're going to give them the money. The issue is, can we leverage that to then make sure the governance is better or whatever else, right? So one of the things, and I'll just digress a little bit, when ASIC did the crowdfunding legislation, they let PTY LTDs raise equity capital, right? Previously, it was generally you'd move to a limited company, right? So you need audited accounts, 3 directors, annual general meeting. So a lot of the things we were talking about here wouldn't exist if we had audited accounts, right? As an example, right? So it all gets back to governance and some of that structure. So part of that is having a good network around you that you know who the advisors are and you say, hey, Mark, come and talk to these guys and hold their hand and we'll do the lending but we'll make sure they're on track, right? Or whatever, right? But there's other things that company could do, right? Or you could say, okay, we'll lend to you, but you've got to move to unlimited. The issue is you probably don't have time to do that. That's part of the issue, right?
All right, listen, we'll wrap it up because we are running out of time. I think that it's fair to say that our conclusion is, I've got 4 things written down here. You need good information when you're capital raising. You need good information on how the business is trading, good information about what's going on in the business. You need to know your worth. I think we've established that. You need good advice early and facing the reality early. And I like to think something I've learnt from Ian over the years is one of the things that certainly Hermes brings to the table. I know it's one of the things that Ian brings to the table is it's not just our money and our specific expertise, but it's our network. And I think it's really important to have the right network, knowing who the phone call to make. Listen, I can't help you with this. But you really need to talk to this and having a solid network, and I think that's not only good for our personal brands, it's also good for what we're trying to achieve when it comes to capital raising. So thank you very much, Mark, Patrick and Ian, and thank you everyone for coming along. We've got a full house, so that's excellent. Thank you.
Thank you.